What is up, people? So, yesterday we spoke about Fibonacci, the concepts of Fibonacci, and how we can add that to extra confluences to know where the market will possibly react from, right? So, today I want to explain in depth how market structure and how the market moves in itself for you to be able to grasp the type of entries and why I count them valid. How I mentioned all of those, right? So let me speak something that respects this. I'm just trying to check out some of the trades I was analyzing yesterday. That GBP JPY hit stop loss. Although that trade has been there since last week. I've held that trade since last week, but and this morning the trade hasn't moved like that. Well, anyways, this is what I predicted yesterday on yesterday's live. That's even touched itself. Mind you, yesterday I did not, this zone I picked, I didn't pick it from any point of interest. I just like picked out where the market will possibly react from. So even if the market was supposed to react, probably to react from here. Your stop loss should be here. The reason why I am picking it from here is just what do you call it? It's just simple sense, the simple sense of it. We have an imbalance here, just like what I explained. And let's say I'm pulling this. So I'm expecting the market to react from this level. And this level I'm seeing a breakout block. Okay, so I can see because the market has already given us a shift around this place, right? Let me draw it out so you can see. Let's see the market is coming here. Came here. Oh, well, the market hasn't given us any major shift. Excuse me. Yeah. I'm sorry. Market structure shift happened here, right? That has confirmed to us that the market is, for a fact, going to go up. So now that the market has done this, created this imbalance, that is how I predicted that the market is supposed to react from here. So let's see. Let me check 15 minutes to even see. You got 5 minutes. I can't see anything here. Higher, low, blah 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 blah. So what am I waiting for? I am waiting for the market. The market has given me a change in state of delivery, right? So it will soon break above this in the next 3 minutes. So after 3 minutes, I can be sure. Then I'll be expecting the market to react off of this level. Right? When the market reacts off of this level, then we can join, or this level, we can join in the buy to the internal liquidity, which might be this place, or to the other targets. This is just the subjective target. I have to enter. I did not enter this trade though, but I will have to enter it. Depends on what the market does. Depends on what the market does. And just like I have always said, follow me on TikTok so you can always see how I share these trades live. What am I expecting the market to do? I'm expecting the market to buy throughout this level, into this level. I can even enter the trade from here. I'm expecting to buy into this level and sell from here. How do I know the market is supposed to sell from here? Same concept, same Fibonacci concept. You see that there are some instances where you use key levels. There are some other instances where you use Fibonacci concepts, you surely can understand. Jesus help me. You definitely can understand what I'm talking about. So, oh, hey, I can't pick skull. Oh. Hey. And they come and beg. I can't pick call now. So you can see that from this level we have 60 to 80%, and I saw a very good order block within this zone where I am expecting the market to react from, right? That is why I am picking this sell level from here. Normally, if you look at gold on a higher time frame, gold is still definitely in a downtrend. We are still definitely in a downtrend, right? We're still in a downtrend. So where are we targeting? We should be targeting this low. But depends on what gold does. So you understand. We react off of what the market is doing. We do not just predict that the market will do like this, the market will do like this, and we just follow it up like that. If the market decides not to do like that, we will still follow it up. So that is what happens. And we have to be careful here because you have to be careful here. See, wetin I talk now. This one don't dey. You don't go touch am, and I've not even entered. Anyways, you will still get re-entries. We are not losing anything. We are not losing anything. We'll still get re-entry. I just personally do not trust 5 minutes, 15 minutes. I don't know. Anything below 30 minutes, I always run. I just personally do not trust it. I prefer 45, 1 hour, 3 hours, and the likes. So I've not entered this trade, but if I get any valid entry, I'm going to share it on the live. So you guys understand the concept I used here to analyze this. Same concept every time. Now I wanted to explain the concept of the key level and the concept of QMR, right? The concept of QMR. The concept of QMR is very simple. There are two types of QMR that I can comfortably explain for you. So these are two types of entries that I could comfortably explain for you, right? This type of entry that we'll explain now is the QMR that respects the higher time frame. Higher time frames QMR. Let me look for some of all those dangerous pairs. All those dangerous pairs that respects QMR. Àwọn pairs tó lórúkọ yẹn na them. They respect QMR a lot. Look at this for instance. I entered through QMR. How did I get that? QMR. This is the higher time frame QMR now. You're going to look at what your market is doing, what the market is doing, right? It's still the same concept as the lower time frame QMR that I explained, or QML or whatever. But this one has more potency, but it doesn't go far. That's just the thing about it. It does not go far. And it can majorly dance around your entry, but it doesn't go far. Virtually your QMRs do not go far, aside from maybe 5 minutes, 10 minutes, and 1 hour. Here we have this. We definitely know the market is in an uptrend from here. I'm looking at this phase now. So the market did this, swept, formed structural liquidity. Now in this instance, this is structural liquidity. In the former instance where I explained to you, the structural liquidity is when the market takes out the high or the low it formed. When it takes it out like this, when it takes it out like this, that is the structural liquidity. But in this instance, the structural liquidity is the low or the high that the key level formed. That's the structural liquidity. It's still the same concept, But the reason why this one is a bit different is because you have to measure your structural liquidity from your QMR level to where the structural liquidity is. And anytime, let me hey, I don't like where my chart is looking foggy like this. Anytime you see that okay, the low or the high that your structural liquidity has formed is touches 50% or 60%, you are sure that this trade will definitely play out. You can see that the concept I explained is different. In the first concept of key level entry, QML, QMC, QMR that I explained in the first, it's like the first or second video, I did not use Fibonacci. I do not use Fibonacci. But in this instance of higher time frame instance now, you can see I'm using Fibonacci for the structural liquidity. And I am marking my entry from the extreme end of the key level after the sweep. Then where will my entry be? Your entry will be that what am I going to call it now? Your entry will be that QML level, that QMR level till your protected low. This now, the sweep that happened in that higher time frame is the protected low. You can see that the market danced around it like it was going to take it above. He still reversed. He did not take it out. It's just that one of the reasons why I don't like using this higher time frame key level is just because it takes loads of space. So imagine waiting 4 hours, waiting days, waiting weeks, and I'm risking, let's say I'm risking $20, all for me to just get $40, 1 to 2 or 1 to 3. So I don't like it. I would rather risk $20 and at least get $60 in the next 3 hours, or in the next 2 hours, or in the next 45 minutes, or in the next 6 hours. Than wait. This is 4 hours. You know how many 4 hours can do? This is where I left the trade. I couldn't wait for the trade to even reach here. Thank God I even left the trade, because it did not eventually reach this place particularly. See, it did not reach this top particularly before it started reversing. I left the trade here, having waited 4 hours, 4 hours. So you can understand the concept. But this entry model, this trading mechanism is only good to be on the safe side. Why I'm saying that is it plays out. This one even plays out more than the lower time frame key level. Lower time frame key level, you can see hit stop loss multiple times, because there are sometimes the market will move erratically, give you structural liquidity, just like I've explained, sweep it, and still go to your stop loss. Let me give you an instance. I took a trade yesterday on although it's a new pair, volatility, what's the name of that foolish pair? Volatility 30, yeah. Very sweet setup. Very sweet setup that I have seen for myself. Is it the one? Is it the one? Volatility 30. Is it the one? No, it's like it is volatility 75. 1 second. 1 second. Yeah, this is it. Although I have an idea that the market is supposed to react from somewhere, but the market didn't give me any sign it's going to react from any, because I was definitely sure it was going to come down. I explain the concept of knowing where your market is. Okay, I've not explained it, but I will explain later. If you want to use QMR, you have to know where the market is coming from so that you do not take a loss. And actually, I suspected that this thing will not play out because I have used my volume profile from here. And I saw that the volume, we have a lot of volume beneath this place, but I still reluctantly still entered from here because the setup was A plus setup, right? So this is the instance of what I'm talking about. If you look at it well, this is a very, very sure setup. This is the key level we have here. Structural liquidity broke beneath this place. Sweep of this key level came down, reacted like it was going to go. It took me out. So it's just something that this QMR doesn't always work. But is it that higher time frame QMR? That higher time frame QMR, oh my god, it works. If not all the time, it works virtually all the time. But it's just that if you want to scale with that, you will do a lot of waiting. You will do a lot of waiting. You will wait a lot. You will wait a lot, right? You will do a lot of waiting. So let me look for another pair to check out. USD card. USD card too. This one safe. I analyzed this yesterday for someone, but I told the person not to enter it because of where the market is coming from. It's already buying. You don't even take out the stop loss, but it is already going up. But the reason why we didn't take this trade was because you look at this place, you can see a very, very strong supply zone. And when I used my volume profile, I could tell that we have a lot of volume up here. When I used it, I used it down. I could tell we had a lot of volume up here. So I knew that the market was either going to react strongly off of this level. So I didn't enter, and I advised the person not to enter. So the concept of the higher time frame QMR, let me just focus on it. And most of the times, the pairs that respect this higher time frame QMR are all these pairs we no get name. Something CHF, something MXN, all those kind of pairs. They are the ones that basically respect. So I'm trying to look for all those pairs we no get name. May I use them show you. So you can see Euro JPY also. Euro JPY, that one no dey. But you understand what I'm talking about now? Pairs that do not have name. Like USD CHF. USD CHF, well, USD CHF too though, but at the same time. Let's look for Euro. All those kind of Euro CHF or card CHF. Mm, mm, mm. Okay, this is one I explained. Let's check Euro CHF. Pairs like this in 4 hours. Oh my god, they respect. Look at okay, this one is not totally valid. I would have said we should use this, a supply zone. But the reason why this one is not valid, remember what I said. We do not have structural liquidity. Let me draw it out. The structural liquidity is supposed to look somewhat like this. Let me draw it out. In a sell scenario, the trade is supposed to look like this. Oh, sorry. It's supposed to look somewhat like this. In a sell scenario, look like this. Do something like this. Do something like this. Come back around this place, then sell. This is a sell scenario. And this is our entry. Our stop loss will be above the invalidation zone. And we definitely have to have structural liquidity. In this instance, we have structural liquidity. We have structural liquidity here. You have to have structural liquidity. You can see that this one does not have any valid structural liquidity. And how do you measure your structural liquidity? You measure it from here. From the invalidation zone to where your entry is. What am I saying? Yes, you're going to measure it like this. From this place to this place like this. If you do not have structural liquidity touching 60%, I might even wait. Let me look for a buy scenario first. So let me just explain. Let me just explain it so you can understand from here. It's like it's from here now to this level. Yes, to this level. What am I doing? Let me see how I explain this so I can. Okay, yeah, it has to be from here to the high of that structural liquidity. Yes. So it has to be from here to where your structural liquidity is. But this one does not have structural liquidity. It does not have structural liquidity, so this is not valid. If you put your entry here, if you wait for it, if you like, wait for it for weeks, put your entry here, there's high chance to take you out. Why? Because this one does not have structural liquidity protecting it particularly. It doesn't have, right? But if you look at this instance now, you can see the first QMR kind of entry I thought. I'm still going to teach this one comprehensively. The first QMR type of entry I thought, look at this. Key level, smaller key level, a sweep of that key level, a take. You can see what I'm saying. When this movement came down, it took this structural liquidity. Now from this structural liquidity, we are marking this out as the entry. And even if we were to measure this, you can, this for instance, to this place, you can see the structural liquidity also. This first value pullback, also a valid structural liquidity. So that's just an extra confluence. No, nothing can make this trade hit stop loss. And if you put your entry here, look at that sniper entry, look at that sweet sniper entry. And you target your 1 to 3 or 1 to whatever, and it will just deliver for you, right? So what did I do here? But this entry model that I used here, that I just explained here, doesn't need any calculation of structural liquidity using your Fibonacci. It doesn't need it. All you just need is that the market sweeps above your key level and breaks this previous key level structural liquidity. The structural liquidity here, it breaks beneath it. Then you're expecting the market to take off that place. So the other kind of entry is the one I am explaining today, the higher time frame type of QMR. But this one particularly has to have structural liquidity. If you look at this now, this is the same instance of what I am talking about. And this in this instance, hey, God help my heart. And this in this instance, if I was to enter, right, I'll have entered from here. The entry will have been from this place. Same thing, I'll have entered from here. Stop loss will have been above this. Same thing. You can see that these concepts, they come together, they align. The concepts align. Let's look for one more pair and we call it a day. Look for one more pair. NSD, USD also, all these kind of pairs, they used to respect these concepts. The way I got this, look at, very beautiful. The way I got this trade, look at it. Very beautiful example. Even if it's dancing around, I'm not in this trade though. I've left the trade. In case you're looking at it and you want to go and enter, I've left the trade. Look at it. This is a key level. This is the structural liquidity. I measured it. And what happened? The structural liquidity touched 60%. Is any structural liquidity close to 50% or more than 50%, that entry is very, very valid. And look at what the market did. The market moved up, came back, still reacted off of, you see, the market will act like it wants to take out this protect. It will not take it out in most instances. Let's just say like 90% of the time. For this kind of entry, it will not take it out. It will not take it out. So this one that has structural liquidity protecting it is very, very strong. You can see the instance here. Very clean, sweet, good instance. The one I entered here is the first type of entry that I thought. All of this, the first type of entry that I thought. But this structural liquidity entry model using QMR is the type that will save you. If you want to scale your money, it will save you. May I plug my laptop? If you want to save your money, it will save you a whole lot, so that you will not be able to, you will not lose too much, and you have many winning streak. So catch you guys later. I hope I explained this concept well. If you do not understand, just drop what you do not understand in the comments. That's even if you guys even watch it till now. Because majority of people, I want to learn forex, I want to learn forex. You do not have the will to really learn this thing. You just want to, let's just say it's just the money that is just entering your eyes. You no wan really learn. Person dey teach you wetin go work now. You are not even, maybe you want someone to spoon feed you. This is the only way, and I'm helping you because this thing has helped me. And there is nothing anybody cannot become. But there's nothing you cannot purchase. There's nowhere you cannot go. There's nothing you cannot do. So you grab. So if you know this thing is definitely going to work out for you, or you just want to have it as a skill, then you should be seeing all these videos seriously, with your notes and all of that, with an objective mind. Alright, catch you guys.